But why don't we start with XRF? So it's a fascinating little business. I think people maybe don't necessarily understand the business too well because it kind of gets like into the weeds of testing, laboratory equipment, consumables, X-ray fluoroscopy. People get a bit like tongue twisted with that one. Can you just maybe highlight what the business does?
Yeah.
And then we'll just roll from there.
Yeah, look, you look at their presentations and you're right. Like your first thought is this is an incredibly complex business, and it is in that sort of laboratory products segment. It's actually an incredibly simple business. So they're exposed to commodity producers primarily. So these guys, if I'm a miner and I'm exploring or digging stuff out of the ground and the grade or whatever of it, I do an assay test, which is just a tube of straight rock mineral. That goes off to the lab. It gets crushed into a fine powder. Some chemicals are then mixed in with that powder and heated up to some incredibly hot temperatures to create effectively a glass disc, and that goes into an X-ray spectrometer. So where XRF comes into that process is historically they've just been those machines that heated up to an incredibly hot temperature. They've expanded a little bit vertically into that chain and bought one of those crushing machines now, business Orbis Mining it's called. But the best way to think about XRF is they make lab machines that heat things to incredible temperatures and are then used to in that sort of assay testing. So they're exposed to mining. There's no doubt about that. The more testing and things like that benefits XRF, but the business is probably not as cyclical as what people believe, because I think when people think about mining and commodity cyclicality, they usually refer to the capex of exploring. So you think about your traditional mining services businesses that are quite cyclical. They need new explorers raising capital, coming to market, going out and drilling and creating new projects. That's not so much XRF. Most of their business is just ongoing mining. So, BHP, Rio, Fortescue, these big guys, they're continually, testing their mines and their product, and that ongoing just mining is XRF. So they do have some cyclicality at the front end. So last couple of years they've done well as that sort of junior mining sector has done okay. But the core business, like Australia, will continue to dig things up out of the ground for a long time, and that's been very steady even through the mining bust. The other aspect of the business I really like that I think gets overlooked is the consumable side of the business. So I mentioned before they put some chemicals that go into the assay that needs to be tested, and they sell these chemicals to clients over and over and over. So they'll sell a machine up front, but then the ongoing chemicals, and it's a very high margin segment, like mid 30% profit before tax margins. It's a beautiful sort of razor blade model. So it's one of the things I've always liked about XRF, and it's sort of a hidden jewel in that business, because they've got a very dominant global market share, like upwards of 50% in that sort of chemical space, which I think is sort of lost on the market a little bit. But that's the business in a nutshell. Like I said, it probably looks more complicated than what it is. Look, jumping into the report, I suppose, come through reporting season, revenue was up 24%. This is one of those businesses I said before, the headline NPAT was only up 17%, that net profit number, but there was some COVID benefits in that prior result. So I was saying before about adjusting last year's result to try and get a clean sort of comparison between the two. Real profits, if you want to call them that, were up 56%. So some good leverage over that revenue growth. The business, the other thing I really like about this business, which again, I think sort of gets lost a bit on the market, is the quality of their balance sheet. So you look at their balance sheet, there's about 50 mil in total assets. Even if you strip out some of their liabilities, there's about 20 mil in just real, tangible, solid quality assets. A lot of that is platinum, which goes into the manufacture of their machinery. They have some chemicals on their balance sheet. So lithium's a big input to their chemical that they use. So they've got some lithium on the balance sheet. They own their property down in Victoria, and they have a bunch of plant and equipment as well. So I think it's a very strong balance sheet, and the liquidation value I think is quite high. They could sell particularly that platinum and lithium back into some very liquid markets. So yeah, that's never been an aspect of the business that's worried me. Same with cash. Cash has always been brilliant. They convert their profits to cash fantastically. Like I said, this was a business that was one, you look at that outlook statement, on the whole, it was quite positive. The thing they did call out, though, is that lithium is a key input for them, and that big EV demand of lithium. So they've called out they expect costs to rise by a double-digit percentage. Now, what I like about this business, they've also said they think they can increase their revenue by that sort of amount as well. So to basically pass on that cost increase to their customers. I give them the benefit of the doubt that they can, because I followed this business for a while. I've owned it for a while. And they haven't put a price increase through to their customers for, I think, 2 or 3 years, certainly pre-COVID. So I think they've got some sort of latent demand there, the ability to pass on some price increases, particularly in this environment where I think customers are probably more receptive to it, because we're all aware of the headlines around inflation and particularly commodity inflation. So going to your customers and say, look, price of lithium is up 10, 15% for us. We're passing that on. I think they have the ability to do that a little bit. So worth keeping an eye on, though, particularly because, that lithium price hasn't really slowed down a great deal. I think maybe they were hoping for it to. It hasn't. So be aware they are exposed to that. And this is in that key consumable segment where those strong margins of 30, 35%, there's a lot of fat that could be eaten away if these lithium prices continue to boom like they are. So that's probably the key risk to the business. But overall, the outlook's quite positive. They have expanded quite well. And they were savvy enough to do it during the mining bust, which I think, we'll talk about Kit McGrath in a second, did a similar thing. A business who can time their CapEx cycles, I think, is a really attractive thing as an investor. So your traditional business, and mining's a great example of this, when we had the mining boom, when times are good, the natural inclination of a management team is to spend that money. The money's coming in the door. Let's go and acquire. Let's go and expand. Let's go and do that. And of course, everyone has that same idea. So your returns on investment are often very, very poor. And the mining boom was a great example of that. So businesses who can be counter-cyclical with their CapEx cycles. And so XRF, when the mining bust happened, that was when they began an expansion into Europe with their products, targeting more of the heavy industry segment like cement and glass and things like that. I find that very appealing. And so they're now coming out of that. So as that commodity cycle has turned for them, their CapEx cycle's also finished out. So you're seeing a real strength in the margins. And you see that they call it their precious metal segment. That's been the segment where margins have really expanded strongly over the last year and a half, and they're calling that to continue. So it's probably going a little bit in the weeds for people, but I think that's something, keep an eye out on that, on how management allocates capital, but more importantly, when. The last thing you want to see is management's getting exuberant when times are good. You'd rather see them do that when times are poor. But yeah, look, I think, they're calling out a couple of new products to be released, sort of in that core laboratory range. But I think
I was going to ask you about that. Have they mentioned much? Do you have any insights into that?
I don't. They're very tight. They're very, very tight.
Yeah.
Even when I've spoken to them and they've done some meetings, probably some competitive stuff around that. So the most I've gotten out of them is that a couple of new products. One will be in that core sort of flux space of the laboratory stuff. But the other one, they've sort of said it's similar technology, but in a different segment. So that's, I attribute no real value to that, but it's certainly some blue sky upside if they can, expand their addressable market into other segments. It's something worth keeping an eye on. But overall, I thought it was a really, really strong result. Just pivoting again, bringing it always back to valuation, because you can talk about how good the business is. You've got to pay the right price. They did about I've got it here in front of me. They did 2.8 mil net profit after tax in the first half, growing strongly. So maybe that comes out to sort of high 5, 6 mil, trading on a 80 mil market cap. So, about 13 times earnings, I think is pretty reasonable for this business, given all those characteristics we spoke about. And importantly, I think the growth, I think you'll see that multiple probably go from 13 to sort of maybe 10, 11 next year as that continues to grow strongly. So, yeah, I think that's fine.
Pays a modest dividend too.
Pays a modest dividend. So it ticks a lot of boxes for me. And, very... Not only a competent management team, but very conservative. I think you see that in the way they run their balance sheet. I have actually sort of quizzed them in the past of whether that's maybe a bit too lazy. They could, leverage up with a bit more debt for sure. But the reply back to me is always a good one. And I'll butcher the quote from the CEO, but it was something along the lines of, that's how a textbook MBA would want to run this business of strip the equity out, level with debt, but a business operator, when you're thinking 5-10 years and the security of your business, you know, you run it conservatively. And of course, you know, credit to him, I was probably telling him that before COVID, when you know, supply chains were hit very strongly. And this is a business that keeps, I think, 9-12 months worth of inventory on hand. So very conservative, pays a nice dividend, reasonable valuation. But I think, you know, the growth is there too, which I think is always important to have in any business, not just a micro cap.